Broadcast is now starting. All attendees are in listen-only mode.
Well, hello everybody. This is AJ Brown with Trading Trainer, and this is our once a month call to the public, for the public, where we answer whatever questions you have burning in your mind about investing, about in trading, just to put it out there. And what we do is, I'm going to share my screen here. We solicit questions each month through our Ask AJ website. So you'll probably recognize this page. If you go to askajonline.com, this is the page we ask you to go to in order to ask your most burning question. And as thanks, we ask you to join this call. We'll also forward you to the replay when it's available. This time around, I got over 141 responses, which is fantastic. And we used our parsing software to go through all those responses and find the top questions. The other thing we did is we went to last month's replay and we verified that we're not going to be asking and answering the same question twice. So I've got a list that my team put together for me of the most popular questions asked this month that don't include the ones we've already answered, and those are the ones that we're going to go for. Now, just as a quick reminder, we do have webinar number 1 from last month already available for you to review if you haven't already. And all you have to do is go to the Ask AJ website and we have the last replay already available. Yeah? Okay. With that said, let's go ahead and begin for this evening. Let me look through these questions that you asked. How to start? I guess that's a good place to begin with tonight's call. How does one get started in investing or trading? I'll tell you one thing. You won't be able to buy a book and become an investor or trader. And for that matter, you won't be able to buy a CD or a home study course or a software or a subscription that makes you an investor or a trader. And you won't be able to sign up for a brokerage and then be able to be an investor or trader. It's very similar to how you can't buy a book about acting or buy a book about engineering. And after reading that book or taking that course or even getting a college degree in the subject, going to acting school, going to engineering school, going to science school, getting a degree, and you don't automatically become a scientist or an engineer, thankfully, because I know I've got 2 engineering degrees myself, mechanical and electrical engineering. And if I would have been considered an engineer the minute I graduated with those degrees, we would have some really messed up machine designs and electronic circuits today, right? Because it takes experience. So with that understood, just understand that to start, you're not going to be able to buy a book buy a CD, buy a subscription, buy a software, buy coaching even, and be able to be an investor. Where to start is with a paper trading account. Most of our brokers now have software built into their brokerage sites, websites that allow you to paper trade. You don't even need that. Even just a simple spreadsheet like Microsoft Excel or Google Sheets. And basically, the best way to start is to follow somebody's recommended procedure to buy and sell a security, record the buy price, record the sell price, and see if you can make a profit. Simulate the trading of these different securities and see if you can make a profit. You can learn a lot by surfing the internet about the different types of investment vehicles out there. If you want to trade stocks, search it on the internet. If you want to trade something that has more complexity, like options or futures, there's so much free material on the internet. Find a procedure, a strategy, and the key is to actually do it. Do it in a paper trading log. The beautiful part about investing and trading versus, for instance, getting into real estate or getting into owning businesses like a franchise is you can paper trade. You can do everything you want and take advantage of all the numbers on paper without risking a penny. You can't do that with real estate. You can't do that with owning a business. Last time I checked, a franchise for Taco Bell was over $500,000. So take advantage of that with investing and trading, that you can do it on paper. And that's how you get started. I would recommend finding somebody who has done it. There's nothing in investing that hasn't been done before. Which, by the way, if somebody tells you that they have something new in trading or investing that is never been done before, they are lying. Every single thing in investing has been done before. So find someone who has done what you want to do and follow in their footsteps. Do it on paper before you do it in real money. And last but not least, do it with others. Find a group of like-minded people to do it with. Do it in a group. Yeah? Okay. Let's go on to the next question. What are the best option trading? No, let's save that one for the next one. How about there's one here that talks about do you think it's basically saying what is the most risk-free investment that makes the most reward? What is the most risk-free investment that makes the most reward? Well, let me see if I can explain this in a way that's crystal clear. There's a graph, and along the x-axis is how much risk is possible, and this can also be how much time is needed and here is reward. Right? How much reward is possible? And what's interesting is it's a pretty linear line. And there's a point early on where it goes from being what I call passive trading or passive investing to active investing. So our Federal Reserve sets something called the risk-free interest rate. And that interest rate is what you get when you put your money into a savings account and you do nothing. And the government insures your money. So that's obviously the lowest amount. Then you have things like CDs. Maybe you have something like mutual funds. Maybe you have things like mortgage-backed securities. These are all very passive accounts, passive investments. You buy them and they go up. ETFs might even fall into that range, but maybe they fall here. Then we cross a threshold where we become active in our investing, where you have to actually take a role. You can't just put your money into something and expect it to grow. Stock trading, real estate, derivatives, baseball cards, whatever it be. And obviously there's more risk involved, but there's also more reward. The other thing is, especially when you get into the active realm, the amount of time that you will need to, number one, invest in learning how to do it. Because doing a mutual fund requires you just buy the thing. I mean, if you know how to go to a grocery store and buy apples, you know how to go and buy mutual funds. You pick up the phone and you say, I want to buy a mutual fund, and that's it. There's nothing to it. If you want to buy a CD, you go to the bank and you buy a CD. It's not rocket science. If you want to start trading options or futures, you're not going to, like I explained in the earlier question of how to start, you're not going to do that right away. You're going to have to do something. You're going to have to learn something, and there's going to have to be an investment in your time to learn how to do it. The best way to learn how to do it is the same answer to the question I just answered about how to get started. You paper trade. So time is going to be needed to learn it, and then also time is going to be needed to keep it going. The other key differentiator is that these things can become second nature if you do them often enough. Because investing or trading, it's a skill like driving a car. If you've driven a car for any amount of time, you probably don't even think about it at this point. You probably get behind the wheel and you arrive at your destination. And unless something significant happened during your ride, maybe a few hours later, if somebody asked you about it, you wouldn't even remember it. You wouldn't even remember getting behind a 1 or 2 ton piece of metal and going great distances from point A to point B and getting out, which is amazingly remarkable. And if you look at the statistics of how many people don't make it from driving, it's incredibly risky. And yet we do it all the time and we don't even think about it. I don't even remember. If you asked me if I drove somewhere last week, I can't tell you that, right? Because I've been driving for so long, it's second nature to me, and it just happens. Do you guys understand that? How many with a show of hands, you can raise your virtual hand in this GoToMeeting system, understand that? So I've been investing in trading, especially in the options market, for now 22 years. And I don't even think about it. And the risk, the time needed, it's built into my daily schedule. Even when I'm on vacation, I still check in for 20 minutes every evening and do what I have to do to keep my investing going. It's literally second nature, like driving a car, like even brushing my teeth. So there's inherent risk in doing it, but because I have the knowledge and experience, that's the word knowledge, that's the word and experience. For me, it's very similar to just buying a mutual fund for somebody that doesn't have the skill that I have. So the first and the second question are very much related. Whereas there's no real answer to what is the best investment strategy versus reward, right? Risk and reward, there's going to be always risk, and the more risk you're willing to take on, and the more time you're willing to put into learning something, and the more time you're willing to manage that something once you've got it figured out, the more reward you will get. But there's no secret, like there's no, as much as the marketing and the gurus out there will try to convince you that they have figured out a way to play with this line so that you can have something that gives you massive reward with minimum risk, that is not the case, right? There's no such thing. And if you fall prey to the marketing behind that, then a lot of those things are buyer beware. So just know that that there is no secret investment that has little risk and maximum reward. all of them fall along this line of if you want little risk, you'll get little reward. If you can take on large amounts of risk, you can get large amounts of reward. And then also understand that risk, well, just like the risk involved with driving a car, can be mitigated through knowledge and experience if you put in the time needed to learn something and build the time needed into maintaining that something into your everyday practice, right? Like I said, people don't even realize how much risk there is involved in driving a car. In fact, most people, it's such second nature to them that they can't even explain to you the last time they drove the car or what they saw unless there was something significant. But if it was just their general path from point A to point B, they do it almost hypnotically now, just like I do with my investing. All right. What are the best option trading strategies for the current market as an option seller? Are calendar spread option strategies good ones when the markets are volatile? That's a great question. So that's actually two questions. Best option strategies for the current market. The current market, ever since the end of what we call the Trump rally, which ended at the end of 2017, beginning of the 2018. The market has been going in a sideways choppy pattern, and the market is currently testing the lower level of resistance in that sideways choppy pattern. Sideways choppy strategies are good for selling option premium, which is what this person said. Now, this person asked also, what is the best option strategy for option sellers? So that person has already recognized that selling premium is the way to go. Which strategy? So let's talk about different selling strategies. Let's also first talk about, and make sure for some of us that are on the phone that need a refresher, when you look up an option price on the big board, what you'll find is that, say for instance, and I'm going to just make something up, the XYZ September at the money option, and we'll use a call. This thing is, we'll give it a price, $4. Now, this $4 is actually a combination of two components. The in the money component, and for you academics out there, this is also called the intrinsic value, and the premium value. And again, for you academics out there, it's called the extrinsic value. So if you add the intrinsic and the extrinsic value together, you will get the current option price. Okay. If we're talking about our at the money call, then the fact that it's at the money means that there's no in the money value. You only get in the money value when you're in the money. If you're out of the money or at the money, the in the money value is 0. So that means that this $4 is probably mostly premium. Say we were in the money. Say we were in the money by $2. Well, then the premium in this case would have been $2 because it has to equal whatever the price is up on the big board. It's this premium component that we are talking about selling. That's what this person's question is all about. Now, what affects these different prices, because it turns out these two components are affected differently by different variables. Like, take for instance this in the money value. This in the money value is actually affected by only two things. One of them is the underlying symbol price. Specifically, the underlying symbol price with respect to WRT, the option strike price. So the underlying symbol price with respect to the option strike price will affect the in the money value. The other thing that will affect the in the money value is the type of option. In other words, is it a call or a put? Now, what's interesting about this, I want to highlight for you what of these variables are set in stone and what of these variables can actually change. And so when it comes to the in the money value, the type of the option, call or put, can't change. It's either a call or a put. The strike price of the option can't change. Only the underlying symbol price can change. So in the money value is actually a fairly stable component of an option price. And people who trade options directionally typically select the options such that there's a lot of in the money value and very little premium value. And therefore, the in the money value behaves very much like the underlying stock price, as you can see, based on what influences the in the money value. So if the option is predominantly in the money value, then it'll move like the stock. We call it a stock replacement strategy. And people who trade options directionally typically use this strategy. And it works well when the market is going up or down reliably. Now, we already said it's not. We said ever since the Trump rally was over, the market's been choppy and going sideways. So with that said, the premium. The premium is a little bit harder to figure out. What affects the premium? Well, it turns out that the underlying symbol price with respect to the strike price also affects premium. It actually affects it differently than it does the in the money value. In the in the money value, it's dollar for dollar with the option, whether it's a call or whether it is a put. It's actually very easy to calculate. With the premium, it looks like this, and then when it hits at the money, it looks like this, and then these are parabolas, and they're very hard to calculate. It's not just a dollar for dollar relationship like it is with the intrinsic value. So it's hard to wrap your mind around how the underlying symbol price with respect to the strike price affects the premium value. The other thing that affects the premium value is time to expiration. And here's another one. We wish that time to expiration affected the premium value linearly. No dice. It affects it exponentially. So that makes it even harder to figure out. All right. There's another component that affects the premium value, and that is the buying and selling pressure, the demand for that option. If a lot of people want it, the premium goes up in value. If nobody wants it, the premium goes down in value. So this premium is a kind of amorphous number. The only thing we know, well, let's first figure out what are some of the things that don't change. Well, the strike price doesn't change, but the underlying symbol price can change. The time to expiration is always changing, and the buying and selling pressure of that option is always changing. So this premium is a really crazy value. Yeah? The only other thing we know about this premium is that at expiration, it's zero. That's a golden rule. At expiration, an option premium is always zero. Another way to say that is at expiration, an option's value is its intrinsic or in the money value, because the premium has gone to zero. So what does that mean? It means, number one, that we can sell premium, and at expiration, it'll be zero. So whatever we sold it for, when it expires worthless, we can keep that money that we sold it for. But we also know that if we sell some premium and it goes down in value because the underlying symbol price moves away from the strike price, we make money that way too. We also can sell premium, and if the demand for the option goes down and the option loses value, we can make money that way too. So with that said, being an option seller, we have quite a few strategies that we can use. We can use a vertical spread. We can use a calendar spread. We can sell premium against an underlying symbol called a covered call or a covered put. We can combine these things into condors, butterfly patterns, two of the most popular, actually, one of the most popular is the condor. And it's two vertical spreads back to back. Okay. The general idea is that this premium value, as the option expires, moves. And when it expires at zero, the value is here. So if the underlying symbol only moves a little bit while you're letting time go by, whatever this value is will move here, and this amount is profit. Yeah? What I don't like about the iron condor is if the underlying symbol moves to either edge, we go down before we come back up. We go down before we come back up. And if we want to exit the position before it expires, maybe it's getting a little bit squirrely and we don't think that it'll stay in this range any longer, unless we sell it right at the tippy top in the middle of the strategy, we're not going to make as much money as we could. In fact, we could lose money. So one of my favorite strategies for selling option premium, and it's not as popular, is called the double calendar spread. And it looks something like this. Now, comparing it to the iron condor, which I'll put up here, they both have 4 options, right? 1, 2, 3, 4. The calendar spread has 2 at the same strike price and 2 at a different strike price, and they have different expiration dates. You have a front month and a back month. And when you look at the combined profit and loss diagram of the calendar spread, it actually looks something like that. So versus having a profit and loss diagram that looks like this, what happens with the calendar spread is that this smile, we call it a smile curve, moves up. And as we get to expiration, it's up here. Whereas this frown curve in the iron condor, the corners of its mouth move up. In other words, if I enter the double calendar spread anywhere towards the center, no matter what happens, whether I go up in underlying symbol price or down in underlying symbol price, not only am I going to make money because this smile curve is flattening out, but also I'll be making money because I'm going up either side of the smile curve. With the iron condor, as I mentioned, it's only down on either side, so you're fighting the direction of profiting. So does that make sense why I like the double calendar spread? If somebody was to ask me what are the best option trading strategies for the current markets, I'd say if you want to learn about them and you want to get into them, the double calendar is a really fun one. And that goes into the second part of the question, which is a calendar spread option strategy a good one when the markets are volatile? The double calendar is very nice when the markets are volatile. So that's a good option selling strategy. Great question. Which then answers, how do you decide which strike price and which month, I guess which expiration date to use for your option? So that goes back to our previous discussion. Our previous discussion, we talked about how the intrinsic value of the option is dependent on the underlying symbol price and whether it is a call or a put. This is the intrinsic value for a call at the strike price. It's 0.00000. At the strike price, it becomes at the money. It's still 0. And then for every dollar it goes in the money, it goes up $1 in value. For a put, it's exactly the same thing, only reversed. Once you hit the strike price, you're at the money. For every dollar below the strike price, you get $1 of value. for a put. That's the intrinsic value. Now on top of that is our extrinsic value, which looks like this. Now notice the extrinsic value has nothing to do with call or put. The extrinsic value doesn't care whether it's on a call or a put, it's the same. And at the money, it's at its highest, and then it's got this parabolic drop on either side, going away from at the money. As time goes by, this little pyramid drops. If the buying pressure for the option goes up, the pyramid goes up. If the buying pressure or the demand for the option goes down, the pyramid goes down. And overall, when the expiration date for the option comes, the premium will flatten out. The mountain will drop. So knowing all of that, and if you look at a call or a put with both values accounted for, you would have its intrinsic value, this is a call, and then you would have the premium, and it would look something like that. When you take that shape and you spread it out on top of it, this is the option price, and this is the premium value, this space in here, and this is the in the money value, this space under this blue curve. So there is a point right here at the money. When you're out of the money, the value of the option is only premium. There is a point once you start getting in the money where it's a combination of premium and in the money value, and then you get to a point where it's just in the money value. We call this, once you hit this point, trading at parity. Once there's no premium left and the only value of the option is in the money value, that's called trading at parity. So knowing all this about option pricing, the idea about what strike price and what exercise price or exercise month, expiration month, it all depends on what strategy you're using the option in. So if you're selling premium, you probably want to use as close to at the money as you can, because you're going to get the most premium, right? That's where the pyramid's at the highest. If you're doing a stock replacement strategy, you might want to use an in the money option, and the deeper you go, the more that option will behave like the underlying stock. If you're trying to have an option, since the time decay curve of an option is exponential, that means if you have an option that's 6 months out, time passing by isn't going to change its value by month by much. So if you want an option that has a time stable value, you have to buy one that's far out in time. So for instance, if I want a back month option in a calendar spread, I'd want to buy that really far, like even use a year out leap. Whereas if I want to sell premium and I want to get as high a price as I can, and I want it to decay to zero as fast as I can, I'll sell a near term or a weekly option. So it depends on what you're trying to do with these, and this is the real excitement about why I became an expert at options. And that's because there's so much flexibility. With an underlying symbol like a stock or an ETF or an index, there's only one or two things you can do. You can either go long or you can go short. You can either make money when the direction is going up, or you can make money when the direction is going down. And that's all you can do. There's two strategies for stocks, commodities, ETFs, indexes. But now when you throw the derivatives into it, like futures and options, in options alone, there's 27 different strategies you can use versus 2. I can make money when the stock goes up. I can make money when the underlying symbol goes down. I can make money when the underlying symbol goes sideways. I can make money when there is some confusion about it. I can make money when there is calm about the markets. I can make money just by watching the clock go because of the what they call theta decay or wasting asset aspect of an option. So I have other variables that if I can match the variable change to what's happening in the market, I can profit. I just have to go into my playbook and pull out the one of the 27 different strategies that fits what's going on in the market right now. Versus in the case of trading stocks, for instance, going long or going short, if one of those 2 strategies doesn't fit with what's happening in the market right now, I'm forced to sit on the sidelines. So how to decide strike and expiration date? It depends on which of the 27 strategies, what you're trying to do. So that was a great question as well. Let's see. I have a small account which I need to grow. What product would best suit my needs and situation of what you are offering? So at Trading Trainer, we have a premium selling program that's very popular, where we focus specifically on covered calls, covered puts, selling covered calls against leaps, and selling covered puts against leaps. Those 4 strategies, and we collar them. So we have some risk in them, risk protection in them. So that's a very popular program I teach. We also have a program for full-time traders. That's my flagship program that I've been running since 2003. And we have some private coaching programs as well. With respect to your small account, I don't all of the option strategies will work with your account. It's not a matter of that. And I feel like with the question that you're asking, we're going back to what we talked about earlier. I feel like you believe that if you buy the program, you can do the strategy. And that's like saying, if I pay the teacher to teach me how to be an engineer, when I graduate the class, I'll automatically be an engineer, which is not true. Again, whether you come to my school at tradingtrainer.com or whether you go to any of the other schools that teach trading out there, none of us have a red or a blue pill that when you pay us the amount to take our course, we can give you this pill and you'll automatically become successful. We also don't have an electrical switch here by our desk that has your name on it, so that when you give us money, we flick the switch and you will be successful. There's no book for you to buy to be successful. The short answer to your question is any of the strategies you pick should work with your small account. The long answer is you're going to have to learn the strategy. So realize that there's learning involved. Okay. What are the best? We already answered that. Do you think that selling options with the stock as collateral is more profitable than just selling option spreads? Great question. So I'm not sure specifically what type of spreads they were talking about. And this question, if it's on my list, was asked more than once. But I'm guessing the most popular is a vertical spread. The scoop is take a covered call, for instance. The vertical spread between the two strike prices. So a vertical spread is where you buy one strike price and you sell back the second strike price and they expire on the same day. The reason why it got the name vertical spread is because when you look at the option charts have your strike prices listed on the vertical axis. So for instance, this would be your September, and then this would be your October and your November. I'm sorry, I just said the strike prices. Let's be sure I'm on the right page. If you have $100, $110, $120, they're all listed down here. And then across the top, you've got your strike expiration dates. So September, October, November, etc. And then the prices for these options, like $4, are in the grid. $6, $8, and then this one might be $3, and so on and so forth, right? And so when we're doing vertical spreads and we're buying the 110 and then we're selling the 130, this is a vertical spread. Whereas a horizontal spread is we're buying the November and we're selling the September. That's a horizontal spread, right? Just a little history just in case you didn't know. So the more popular spread, which I think this person is asking about, is a vertical spread where different strike prices, same expiration month. The issue with a vertical spread is your total investment is at risk over the distance the underlying symbol goes between the strike prices. So if this is the 100 and this is a 110, your total investment with a $10 movement of the underlying symbol will be lost. 100% of your investment will be lost with just a $10 movement of the underlying symbol. With a covered call, the underlying symbol has to go all the way to 0 for you to lose your total investment. So if we're at 110, the underlying symbol would have to go all the way to $0, move $110 in order to lose your investment. So it's not a matter of reward, it's a matter of risk. If you remember in the beginning of the call, I showed you that graph that showed that the amount of risk you're willing to put in is commensurate with the amount of reward you could get. So I like vertical spreads, don't get me wrong. They're a very good active trading strategy, and if you know how to do them, the reward potential is high. And you can learn how to do them to a point where it's second nature. But the inherent risk is incredibly higher than there is in a covered call. So if you're just getting into premium selling and you don't want to become an active trader. You'd rather just spend 20 minutes at the end of every day deciding what to do next, most of the time doing nothing, maybe doing 5 or 6 transactions a month, and being able to make over 10% returns per month. The covered call is a perfectly fantastic strategy. If you want to be more active, which means now you're going to have to be logged in and watching trades during the day, then vertical spreads or horizontal calendar spreads are fantastic strategies. And the reward is there, but the inherent risk and the amount of time that it's, number one, going to take you to become comfortable and familiar with the strategy, and number two, the amount of time you're going to have to do to maintain the strategy is going to be much higher. Great question. It looks like we have time for one more quick question, and then we're going to draw this month's call to a close. And it looks like the ones that I've got here is early August, the Dow dropped some 800 points. How do you address such situations where you have massive swings? What's the purpose of an option? Why did call options get created in the 70s and put options get created in the early 80s? They weren't created for smart, mathematically minded whippersnappers like me to come up with 27 different strategies to use them to profit in any market condition, I'll tell you that. Options were created as hedges for market movers, people who buy large amounts of stocks, to protect against volatility. Because if I'm buying a stock and a stock is rising, and I decide at this point to buy a put option that has a strike price here, and the stock continues to rise, and then all of a sudden does what a stock likes to do. The bull likes to climb up the stairs, and the bear likes to jump out the window, and the stock plummets to below the value of that strike price. For every dollar that put option is in the money, that put option will pay me $1 back. In other words, it will offset my losses dollar for dollar. Options are hedging mechanisms. That is why, if you remember earlier, I talked about very briefly that the premium value can go up when the demand of an option goes up. And you might have either glossed over that, or you might have maybe asked yourself at the moment, why would there be a demand for an option? Well, if people who own these stocks believe that there's some proverbial poop coming to hit the fan pretty soon, they will buy these options up in order to protect themselves. And if they start buying those options up to protect themselves, in other words, if they start hedging their trade, in other words, if they start making a run on those options, the price of those options is going to go up. The premium value is going to go up. Just like in the 80s when I was a teenager, these god-awful ugly dolls that had like their eye in some weird place and their nose over here, they were called Cabbage Patch Kids. One holiday season, there was this demand for Cabbage Patch. I mean, you would go to the toy store at midnight and the parents would be fighting each other in the halls of the toy store over these god-awful ugly smelly, they would take on the odors of whatever they touched, dolls called Cabbage Patch Kids. And you'd see them, people selling them like behind like trailers and stuff. Hey man, I got a Cabbage Patch doll. I'll sell it to you for $300 or whatever. There was like a street price for them. And that's because the demand for them was high, right? And then like 4 years later, nobody wanted them and you could get them for like $10, right? So there's definitely, when there's a demand for something and there's limited quantities, the price goes up. Well, the scoop is we can actually take the price of an option and we can extract from it its in the money value. And further, we can extract from the premium what effect time to expiration has on it. And we get left with this value that is attributed to the buying and selling pressure. And we call that the implied volatility, which is different than historical volatility, which is a number we can actually measure. Historical volatility, you can look at a chart and you can say, yesterday, the amount between the high and the low was much higher. There's a higher historical volatility. But implied volatility is understanding the fear that people have in measuring their need to hedge their positions, right? An interesting fact is, if a stock or an ETF is not optionable, you cannot measure implied volatility. You need to have a secondary derivatives market in order to calculate implied volatility. It's implied because it's not something you measure. It's implied in how much demand there is for the insurance policies, the options. When you look at a stock's implied volatility measurement, what you're really looking at is the mathematicians go in and they calculate the implied volatility for every single one of the options in the option chain, and then they average them together to get the stock's implied volatility. And that's why the implied volatility and the historical volatility are not the same. The historical volatility is measuring the actual volatility you've been seeing to date. The implied volatility is what people expect is going to happen and have therefore bought the derivative to protect themselves against it, causing the derivative to go up in price. So with that said, when it comes to handling the swings in the market, my answer is you hedge them. You hedge them. You do adjustments on your positions. And therefore, you buy a put or a call when the going makes sense to, that will protect your position when there are massive swings. And if you are not protected, if you don't have the collar protection, then you do the same thing that stock traders do. And that is, you use a stop loss order and you bail out of the position when the going gets tough. So let's see. We talked about how to start. And after talking about how to start, we talked about what is the best strategy with the least amount of risk and the most reward. And then after talking about that, we went in there and we talked about what is the best option trading strategy for the current market as an option seller. And we talked about the calendar spread. Then we talked about how to pick strike prices and expiration dates. We talked about covered calls versus vertical spreads and even horizontal spreads. And finally, we said, how do we protect ourselves in this extremely uberly volatile market? Great Ask AJ call. If you did purchase the transcript will be available shortly. And the replay will be even available faster than that. We'll send you an email. And don't forget, we'll already get this set up in the next few hours for Ask AJ webinar number 3. Webinar number 1 is ready for you to replay. It's been ready for weeks now. And webinar number 2 will be ready in the next hours. Thank you so much for joining me. Stay tuned for the replay and stay tuned for our Ask AJ next call in about a month's time. Take care, everybody. Thanks. Bye.